The government is not the solution, but rather the cause of our problems. Ronald Reagan. Welcome and thank you for joining me. Today we're going to take a closer look at the real timeline of the U.S. financial crisis, not just the 2008 collapse, but the financial economic unraveling that started in 1992 and didn't fully resolve until 2018. We often think of the financial crisis as a sudden collapse in 2008, but in truth, the seeds were planted over a decade earlier. In 1992, regulators began loosening mortgage lending standards, and over time, government-sponsored enterprises like Fannie Mae and Freddie Mac increased their exposure to risky loans. By the late 1990s, the Federal Reserve under Alan Greenspan maintained easy monetary policy that encouraged borrowing and risk-taking. In 1999, Congress repealed parts of the Glass-Steagall Act, allowing investment banks and commercial banks to merge, fueling massive risk concentration. What followed was a housing bubble in the early 2000s, built on low interest rates, aggressive Wall Street speculation, and a credit system increasingly disconnected from reality. Over the next 2 decades, the Federal Reserve interventions from rate cuts to quantitative easing would define the crisis response, in many ways contribute to the long-term weakening of the U.S. dollar. Let's walk through this story.
More rip-offs. The savings and loan scandal could cost $500 billion. But in Washington, the big question still is who gets the blame. Today, the president and his congressional critics gave a preview of the positions that they'll be taking to the voters later this year. More on that now from NBC's John Cochran.
Trying to deflect charges that he has pussyfooted on S&L fraud, President Bush told federal prosecutors from all over the country to intensify their efforts.
We will not rest until the cheats and the chiselers and the charlatans spend a large chunk of their lives behind the bars of a federal prison.
Democrats, smelling blood on the S&L issue, accused Bush of using federal attorneys as props for a photo op.
And I don't know what it costs to fly all those U.S. attorneys in here, but I assume it cost a fair amount. I don't think they got a thing done.
Bush did promise to give prosecutors more help, including more investigators. Democrats fired back that the new Bush plan is a rehash of the one unveiled by his own Justice Department last December, which also called for more investigators.
The president told us today that he was going to hire 202 FBI agents. On December 7th, Attorney General Thornburg said on page 4 of his release a total of 202 FBI agents.
Democrats think the president is vulnerable partly because his son Neil is under investigation as a former director of a bankrupt thrift firm. Republicans say Democrats are desperate for an issue.
And some slick consultants believe it's the best way to proceed is to attack President Bush. The best way to take on President Bush with a record-breaking popularity and job approval rating is to somehow go after him on an S&L matter.
Both parties have suddenly discovered that voters are angry about the S&L fiasco and will be angrier if asked to pay for it with higher taxes. John Cochran, NBC News, the White House.
In the mid-1990s, changes to the Community Reinvestment Act encouraged lenders to make more subprime loans. Meanwhile, in 1999, the partial repeal of the Glass-Steagall Act allowed banks to merge commercial and investment activities, and exemptions for credit default swaps added systematic risk. In the early 2000s, the Federal Reserve slashed interest rates in response to the dot-com crash, fueling an easy credit boom that helped inflate the housing bubble.
Bear Stearns shareholders have approved J.P. Morgan Chase's $2.2 billion buyout of the investment bank. The bargain rate deal of $10 per share is a significant discount from the $171 Bear Stearns was trading at before mortgage defaults began clobbering banks and draining demand from the debt markets. Since offering to take over the firm 2.5 months ago at the behest of the U.S. government, the deal's approval comes as no surprise. Analysts say it has helped to calm the markets.
Bear Stearns, although the smallest of the investment banks, is a major trading partner of all of Wall Street hedge funds. There would have been tremendous ripple effects throughout the system if it had failed.
But just as the world's financial system has far to go in recovering from bad bets on debt, so does J.P. Morgan in its integration of Bear Stearns. Not only will it have to effectively manage the approximately 7,000 new employees, it will have to retain the clients of what was the nation's 5th largest investment bank.
By 2007, fragility was obvious. In March 2008, Bernstein's collapsed and was acquired by J.P. Morgan Chase with Fed support. On July 11, 2008, IndyMac failed, the fourth largest bank failure in U.S. history at the time. Shortly after, on September 7, Fannie Mae and Freddie Mac were placed under federal conservatorship to stabilize the housing market. The firestorm peaked on September 15, 2008, when Lehman Brothers fell for the largest bankruptcy in U.S. history, triggering a massive market crash and widespread panic.
The bailout was far bigger than the Federal Reserve let the public or even members of Congress know at the time. In fact, from the start of the financial crisis in 2007 through March of 2009, the Fed loaned or guaranteed the banks some $7.7 trillion, about half the value of all the goods and services produced by the U.S. economy. That's 11 times the $700 billion in aid provided by the Treasury Department's better-known Trouble Asset Relief Program, or TARP. On just one day, December 5th, 2008, America's banks borrowed $1.2 trillion from the Fed. Furthermore, says Bloomberg, the banks borrowed that money from the Fed at as little as 1/100% interest. As a result, the banks were spared the need of selling off assets that paid much higher rates of interest. Bloomberg estimates the banks made a $13 billion profit on the spread on money they borrowed virtually free from the Fed. Bottom line, the nation's sixth largest banks saw their assets grow by 39% from September of 2006 to September of this year, from $6.8 trillion then to $9.5 trillion now. For its part, the Fed says its loans to the banks were all backed by collateral, and that almost all of the loans have now been repaid.
In response, Congress approved the Emergency Economic Stabilization Act in early October 2008, creating a $700 billion TARP bailout to purchase toxic assets from financial institutions. Meanwhile, the Federal Reserve launched an array of emergency lending programs, like the Commercial Paper Funding Facility, to inject liquidity into frozen markets.
Centerpiece is the Bureau of Consumer Financial Protection that will be housed within the Federal Reserve. It's charged with regulating financial products, including mortgages, credit cards, and student loans. The legislation also gives broad new powers to the federal government, allowing it to take control of and shut down large financial institutions like Lehman Brothers, which went bankrupt in 2008. President Obama hailed its passage.
Because of this reform, the American people will never again be asked to foot the bill for Wall Street's mistakes. There will be no more taxpayer-funded bailouts, period.
But critics say the bill fails to reform mortgage giants Freddie Mac and Fannie Mae, does not create a fund to help shut down big banks when they fail, and gives too much power to federal regulators to create reams of new rules. Republicans who almost universally opposed this legislation argue it will curb growth and kill jobs at a time when the nation can least afford it.
I think it ought to be repealed.
Still, former investment banker Douglas Elliott believes the bill is better than doing nothing.
The bill addresses most of the problems and makes a good start. It's not perfection, but in the real world, we don't get perfection.
In February 2009, the American Recovery and Reinvestment Act was signed into law, a stimulus package totaling roughly $787 billion aimed at jumpstarting the economy. The National Bureau of Economic Research declared the Great Recession officially over by June 2009. Still, the road to recovery was long. The unemployment rate kept climbing and foreclosures set new records.
It's been 7 years since the worst financial crisis in generations spread from Wall Street to Main Street. A crisis that cost millions of Americans their jobs, their homes, their life savings. It was a crisis that cost all of us. It was a reminder that we're in this together, all of us. That's how we've battled back these past 6.5 years, together. We still have work to do, but together we prevented the Second Great Depression. Our businesses have created nearly 13 million jobs over the past 64 months. The housing market is healthier. The stock market has more than doubled, restoring the retirement savings of millions. Americans of all stripes buckled down, rolled up their sleeves, and worked to bring this country back. And to protect your efforts, we had to do something more. We had to make sure this kind of crisis never happens again. That's why 5 years ago this week, we enacted the toughest Wall Street reform in history. New rules of the road to protect businesses, consumers, and our entire economy from the kind of irresponsibility that threatened all of us. 5 years later, here's what that reform has done. Wall Street reform turned the page on the era of too big to fail. Now, in America, we welcome the pursuit of profits. But if your business fails, we shouldn't have to bail you out. And under the new rules, we won't. The day of taxpayer-funded bailouts are over. Wall Street reform now allows us to crack down on some of the worst types of recklessness that brought our economy to its knees, from big banks making huge, risky bets using borrowed money to paying executives in a way that rewarded irresponsible behavior.
This is truly a great day for America and a great day for American workers and small businesses all throughout the nation. The legislation I'm signing today rolls back the crippling Dodd-Frank regulations that are crushing community banks and credit unions nationwide. They were in such trouble. One size fits all. Those rules just don't work. And community banks and credit unions should be regulated the same way, and you have to really look at this. They should be regulated the same way with proviso for safety as in the past when they were vibrant and strong, but they shouldn't be regulated the same way as the large, complex financial institutions. And that's what happened, and they were being put out of business one by one. And they weren't lending. Since its passage in 2010, Dodd-Frank has dealt a huge blow to community banking. As a candidate, I pledged that we would rescue these community banks from Dodd-Frank, the disaster of Dodd-Frank. And now we are keeping that commitment, and all of the people with me are keeping that commitment. Incredible group of people. Dodd-Frank's complex and costly regulations gave large banks an unfair competitive advantage at the expense of neighborhood banks all over the country. Since Dodd-Frank's passage just 8 years ago, 20% of small banks have been put out of business. They're disappeared. While banks that were considered too big to fail, we've heard that many times, too big to fail, had the resources to comply with Dodd-Frank's brutal maze of costly regulations. And maybe we're going to have to start looking at that also for the larger institutions, because they also are put at a disadvantage in terms of loaning money to people wanting to open up businesses. So perhaps we'll be taking a look at that. Many small banks were forced to shut down.
In July 2010, the Dodd-Frank Act was enacted, overhauling financial regulation with tools such as the Consumer Financial Protection Bureau, orderly liquidation authority, and stricter oversight of systematically important institutions. Even though the act was aimed at preventing future meltdowns, aspects of Dodd-Frank were later rolled back under the Trump administration, highlighting the ongoing balancing act between regulation and deregulation. In conclusion, to sum this video up, the crisis stemmed from relaxation regulation, risky lending, and unchecked leverage. What followed was near collapse, massive government intervention, slow recovery, and sweeping reform. Yet vulnerabilities remain. With all things considered, now do you see why we are moving into a digital system? Billions of dollars are lost in these new reforms and acts. There is no true transparency between politicians and the citizens they're supposed to support. Every 4 years, the new administration just repeals the previous administration laws. This antiquated form of government is old. A new government is being built that fact checks the politicians and every transaction through blockchain technology. Thanks for watching. If you found this breakdown helpful, hit like, subscribe, and let me know which economic event you'd like to unpack next. Peace.